August 15, 1971. President Nixon walks into a television studio, looks straight into the camera, and says 5 words that will quietly destroy the savings of millions of Americans. We must protect the dollar. What followed was one of the most consequential financial decisions in modern history. And almost nobody who lived through it understood what had just happened to them, until it was too late. Right now, a lot of people are asking whether Bitcoin is the hedge against what's coming. And it's a fair question. But before you buy a single Satoshi, you need to understand what actually worked the last time the dollar was in serious trouble. Because we have a playbook, a real one, tested in fire, and most people have never read it. Stay with me, because by the end of this video, you're going to see the 1970s in a completely different light, and it might change how you think about the next decade entirely. So let's go back to that August night in 1971. For 27 years, the global financial system had run on a simple promise. Every U.S. dollar in circulation was backed by gold. $35, 1 ounce. Foreign governments could walk up to the window at the U.S. Treasury and exchange their dollars for physical gold. It was called the Bretton Woods System, and it was the bedrock of global confidence in the dollar. Nixon ended it in a single evening. No congressional vote, no public debate. He just closed the gold window. The dollar was now backed by nothing except the government's promise to keep it valuable. And almost immediately, the market started testing that promise. Here's what happened next, and this is the part they don't teach you in school. From 1971 to 1980, the dollar lost roughly 50% of its purchasing power. Inflation peaked at 14.8% in 1980. If you had a savings account, a pension fund, or a bond portfolio, you were getting quietly wiped out in slow motion. The number in your account went up, but what that number could actually buy went down steadily, year after year. And here's the gut punch. This wasn't just inflation, it was stagflation, a combination the textbooks said couldn't really happen. High inflation, plus economic stagnation, plus rising unemployment, all at once. The stock market went essentially nowhere for most of the decade after adjusting for inflation. Real returns on bonds were negative. The conventional playbook, the one every financial advisor was running, was getting destroyed. But some people made extraordinary wealth during this exact period. If you had bought gold in 1971, when Nixon severed the dollar's link to it, you paid around $35 an ounce. By January 1980, gold touched $850 an ounce. That's a gain of roughly 24 times your money in 9 years. Silver went from about $150 an ounce to nearly $50. Energy stocks, commodity producers, companies tied to real physical resources, they outperformed broad markets by extraordinary margins throughout the decade. These weren't lucky guesses. They were the logical consequence of what happens when you flood a system with currency that isn't anchored to anything scarce. Here's the principle, and once you understand it, you'll never look at inflation the same way again. When a currency loses purchasing power, prices of scarce physical things rise to compensate. It's not that gold became more valuable, it's that the dollar became less valuable, and gold, which cannot be printed, reflected that reality. The same mechanism applied to oil, copper, wheat, farmland. Anything with genuine scarcity and real-world utility became a store of value almost by default. Speculative assets, things valued primarily on future expectations or narrative, got crushed. Because during inflationary periods, the cost of capital rises, interest rates rise, and the present value of future promises collapses. Investors flee to things that are valuable right now, not things that might be valuable later. This is the 1970s Playbook in its simplest form. Scarce physical assets tied to real production outperform speculative assets when currency loses credibility. Now pause here, because this is exactly where Bitcoin enters the conversation, and I want to be honest with you about this because the Bitcoin argument is genuinely interesting, and it deserves a serious answer rather than a dismissal. The case for Bitcoin as an inflation hedge is built on one core idea. It's scarce. The supply is capped at 21 million. It can't be debased by a central bank the way the dollar can. In theory, it's digital gold. And if we were purely looking at the design of the asset, that argument has some merit. But here's where the 1970s Playbook creates a problem for that thesis. Gold's performance in the 1970s wasn't just because it was scarce. It was because it was already a proven, globally trusted store of value with a multi-thousand-year track record. When confidence in the dollar collapsed, people didn't run to something new and experimental. They ran to something ancient and tested. The psychological dimension of that trust cannot be separated from the financial performance. Bitcoin has existed for 15 years. It has never been through a true stagflationary cycle. The 2021 to 2022 period saw Bitcoin fall more than 75% in value during the same months that inflation was running hot. That is the opposite of what a stagflation hedge is supposed to do. Now Bitcoin recovered and went on to new highs. But the pattern in that window looked nothing like gold in the 1970s. This isn't an argument that Bitcoin will fail. It's an argument that we don't actually know how Bitcoin behaves during the specific conditions the 1970s produced, because it wasn't there. The 1970s playbook is proven. Bitcoin's role in that playbook remains theoretical. And if the conditions of the 1970s are beginning to reassemble themselves around us, that distinction matters enormously. Here's why some serious analysts are making that comparison right now. U.S. federal debt has crossed $35 trillion. The interest payments on that debt now exceed the entire military budget. The Federal Reserve spent years running near zero interest rates while the money supply expanded dramatically. Inflation, while lower than its 2022 peak, proved stickier and more persistent than the transitory label suggested. Geopolitical shifts are accelerating, particularly the very slow but visible movement of some countries away from dollar-denominated trade. These are not identical conditions to 1971, but the structural patterns, excess debt, currency credibility questions, supply-driven inflation in commodities and energy, rhyme closely enough that the 1970s playbook is being dusted off by investors who study history. And here's what that playbook actually looks like when you build it into a portfolio. First, precious metals, not as speculation, but as insurance. Gold's function in the 1970s wasn't to make people rich. It was to preserve purchasing power when the currency was failing to do so. An allocation to gold isn't a bet that the world will end. It's an acknowledgement that monetary history contains periods where holding gold was the rational response to policy decisions already being made. Silver played a similar role with even more volatility, which means higher potential returns and higher potential losses. Second, energy and commodity producers. This is where the 1970s playbook gets more nuanced and more interesting than just buying gold bars. Companies that extract, refine, and deliver real physical resources have revenue tied directly to the prices of those resources. When oil goes from $3 a barrel to $35 a barrel, as it did during the 1970s, the oil companies aren't just surviving inflation. Their revenues are moving in lockstep with it. They become, in effect, an inflation-adjusted income stream. The same logic applies to copper miners, agricultural companies, and energy infrastructure. These aren't just assets that preserve value. They can actually grow wealth during inflationary periods. Third, real assets tied to production. Agricultural land, productive physical infrastructure, assets that generate something the world needs regardless of what currency is being used to price it. The farmer's output doesn't become worthless because the dollar weakens. In some ways, it becomes more valuable because it takes more dollars to buy the same bushel of wheat. This is the complete 1970s playbook. Precious metals for preservation, commodity and energy producers for inflation-linked growth, productive real assets as a foundation. Now you might be asking, why not just add Bitcoin to this mix and get the best of both worlds? You can, and many investors do. But the honest answer is that Bitcoin's position in this playbook is the one part that history hasn't validated yet. It might perform like digital gold in a sustained inflationary cycle. It might behave more like a risk asset and fall when conditions get genuinely scary. We don't know because the test hasn't been run at full scale. What we do know is what worked in the actual 1970s. And the investors who understood that playbook didn't panic. They didn't pick one asset and bet everything. They diversified across the category of assets that share a single key characteristic: scarcity, tied to something real, something the world cannot simply print more of. Here's the part that should genuinely unsettle you. Most people in 1971 didn't understand what Nixon's announcement meant for their savings. They went to work, deposited their paychecks, trusted the system, and spent the entire decade watching the purchasing power of those savings quietly erode. They weren't stupid. They just weren't looking at the right framework for understanding what was happening. The people who preserved and grew wealth during the 1970s were the ones who recognized the shift early and repositioned before the full effects played out. By 1979, it was obvious. By 1975, it was becoming clear. By 1972, it was already implied in the decision that had already been made. The question is always the same. Do you see the pattern before or after it's already happened to you? If this breakdown gave you something to think about, hit subscribe. This channel is about building the kind of financial literacy that institutions don't have an interest in teaching you. Every week, a new lens on how money, history, and strategy intersect. Drop a comment below and tell me which part of the 1970s playbook you think is most relevant right now. I read every single one, and the conversations in the comments are consistently more interesting than most financial media. The playbook exists. The history is documented. The question was never whether the 1970s happened. The question is whether you'll be holding the assets that worked when the conditions come around again.